Welcome to the Deep Dive, powered by Talk Tickers. We're your shortcut to getting truly well-informed on earnings.
That's right. Today, we're digging into Ericsson's Q2 results for fiscal 25. They came out July 15th.
Yep, and we've gone through the reports, the numbers, the call transcript, all of it.
Our mission here is simple. Cut through the noise, get past the headlines. We wanted to distill what really mattered this quarter for Ericsson.
And help you understand the numbers, yes, but also the strategy behind them, especially given, well, the market's pretty sharp reaction.
Exactly.
Okay, so let's kick off with the snapshot, the headline numbers. Ericsson reported net sales of SEK 56.1 billion.
Right. And that actually came in below what the street was looking for. Consensus was around SEK 59.4 billion.
So a top-line miss. Pretty straightforward there.
It was. But here's where it gets interesting. On the bottom line, adjusted EPS, they delivered SEK 1.56.
Which comfortably beat the expectation of SEK 1.28. So revenue miss, profit beat.
Precisely. And that beat wasn't just, luck or a one-off. It was driven by a really impressive adjusted gross margin.
48%. That's their best in 3 years, isn't it?
It is. And it signals, I think, a real focus on value over just volume. You see it in the mix, more North American sales, which are higher value, and a big chunk of IPR licensing revenue.
Intellectual property rights, that licensing income.
Exactly. And that strong margin performance, well, it more than doubled their adjusted EBITDA.
Earnings before interest, taxes, and amortization, a key profit metric, doubled.
Yeah, huge operational leverage there.
Okay, so a mixed picture, but strong profitability. Yet the market didn't seem impressed.
No, it reacted pretty negatively. The stock dropped, almost 8% the next day?
7.9%, yeah. And on more than double the normal trading volume, lots of put buying too, suggesting people were betting on further downside.
It seems like investors maybe cheered the margin for a second, but then they really fixated on that sales miss.
And maybe those fresh worries about U.S. tariffs. Plus, the guidance didn't get that explicit upgrade some bulls were hoping for.
Right. It highlights how sensitive the market is right now, especially in this sector. We even saw Nokia dip a bit in sympathy.
So, broader caution across telecom equipment. Ericsson's profit story wasn't enough to overcome that, it seems.
Not on the day, anyway.
No.
Which makes it even more important to understand how they managed that profit beat.
Agreed. Let's peel back the layers then. Dig into the financials, the operations. How did they do it?
Well, first off, that reported sales decline of 6%. You have to factor in currency. There was a big SEK 4.7 billion negative impact from FX.
Ah, okay, so organically.
Organically, sales actually grew 2%. That's a critical difference. They're growing the underlying business, currency headwinds aside.
Got it. And the profit driver, you mentioned IPR.
Yeah, that was a major factor. IPR revenue jumped to SEK 4.9 billion in Q2. That's up significantly from Q1's 3.2 billion.
And that's mostly catch-up payments for past periods.
Primarily related to previously unlicensed periods, yeah. But importantly, they exited the quarter with an IPR run rate around SEK 13 billion annually. That's a strong, high-margin income stream.
Okay, so IPR, a better product mix. What else? Cost cutting?
Definitely. Operating expenses, if you exclude restructuring charges, came in at SEK 20 billion. That's about SEK 3 billion lower than last year.
Wow. And how much of that was cost actions versus currency?
Management said about half was from their cost initiatives, the other half from favorable currency movements on the expense side.
Interesting. So they achieved organic growth while cutting costs significantly. They mentioned a 6% reduction in headcount, right? About 6,000 people.
That's right. It suggests they're getting leaner, more efficient, perhaps using automation more, or maybe just focusing resources better. It's not just cutting. It seems structural.
And all that flows down to that EBITDA number we mentioned, up SEK 3.4 billion to SEK 7.4 billion.
Giving them that really healthy 13.2% adjusted EBITDA margin.
What about cash flow?
Free cash flow before M&A was positive, SEK 2.6 billion. Now, that's down from last year.
Okay.
But last year had a huge benefit from working capital release as some big roll-up projects finished up. So this year's number is probably more, let's say, normalized, whereas last year was unusually high.
Got it. Makes sense. Okay, let's break it down by segment. Networks, the biggest piece of the business.
Right. Network saw organic sales up 3%, even though reported sales were down 5% because of that currency impact again.
And regionally, where did the growth come from?
Strong performance in the Americas, especially North America. That's a high-value market, so good to see.
But offset elsewhere.
Yeah, sales were down notably in India. Management called it a temporary investment pause there.
Okay, temporary, but expected to continue into Q3.
That's what they indicated, yes. And also weaker sales in Northeast Asia, Seems like reduced 5G spending by customers there.
So a mixed bag geographically. But the network's margin held up.
Very strong, actually. Adjusted gross margin was 49.5%. Really robust, though they did mention some impact from tariffs and maybe a slightly less favorable mix compared to Q1, but still very high.
Okay. What about cloud software and services, CSS? That margin looked impressive.
It really did. 43.2% adjusted gross margin. Very strong for that segment.
What drove that?
They said it was a higher share of software revenue, which carries better margins, plus some of that increased IP revenue allocated to the segment, and just better delivery performance focusing on efficiency.
And they're still aiming for double-digit EBITDA margins there midterm.
That's the target. Shows they're serious about making that segment consistently profitable.
Right. And the last one, enterprise.
Enterprise organic sales were down 6%, mostly driven by their global communication platform business, where they consciously decided to pull back from some countries.
Scaling back less profitable activities.
Seems like it. Management expects enterprise sales overall to stabilize organically during 2025. So they think the pruning is mostly done.
But did the margin improve there, even with lower sales?
It did. Adjusted gross margin in enterprise actually increased to 54.9%, driven by a better mix. Still running at an EBITDA loss, about SEK 0.5 billion, but the quality of revenue seems to be improving.
Okay, so better quality, finding its footing. Let's shift gears from the numbers to what management was saying, the strategy, the outlook. Costs first. They talked a lot about efficiency.
They did. They highlighted those cost actions over the past year, cutting headcount by 6%, about 6,000 roles, while still growing organically. That's doing more with less.
Is it sustainable? Are they cutting muscle?
It's a fair question. They frame it as structural changes, combining market areas, using more AI internally. They seem to believe they can maintain this leaner structure and find more efficiencies. The proofs will be in continued innovation, of course.
Right. And the market overall. RAN market.
The radio access network, yeah. They expect that market to be broadly stable for the rest of the year. The macro environment is still a bit uncertain, fluid.
But stable isn't growth. They need new ways to make money, right? Monetization.
Absolutely. Management stressed that. They pointed to things like fixed wireless access, FWA, using 5G for home broadband. Apparently over 160 million subscribers globally now.
And high satisfaction scores, they said.
Yeah, high net promoter scores, often better than fiber. So that's one area. The other big one is unlocking the potential of 5G standalone networks.
5GSA, what does that enable?
Things traditional 5G can't do as well, like network slicing. Dedicating a slice of the network for a specific guaranteed performance, say for mission-critical apps.
Correct.
Or using network APIs, application programming interfaces, to let developers build services on top, like fraud detection using network data. Their joint venture, Aduna, is doing this in Japan with all 3 major operators now.
Interesting. And AI, it's everywhere, but Ericsson seems serious, talking about an AI factory consortium.
Yeah, they're not just talking the talk. They see AI as fundamental. This consortium in Sweden gives them access to top-tier chips and computing power.
But how does it actually help their business, beyond internal efficiency?
Well, efficiency is part of it, designing and operating networks more autonomously. Think intent-based or even self-driving networks eventually. That drastically cuts operating costs for their customers.
Okay, lower OpEx for telcos.
But also, AI applications themselves, especially at the edge, will drive traffic and require the kind of low latency and guaranteed uplink that 5GSA provides. So AI both optimizes the network and creates demand for the network.
It's foundational then.
That's how they see it.
They also mentioned focusing on key home markets. What's the strategy there?
It seems like doubling down where they have strong roots or advantages. The US, they have R&D and a factory there. India manufacturing, big R&D presence. Japan setting up new R&D.
So deepen the relationships in core markets rather than spreading too thin.
Exactly. They sounded confident about strengthening their position, especially in India and Japan, despite the current pause in India.
And the tariff question, that keeps coming up.
They basically baked in about a 1 percentage point hit to margins going forward from existing tariffs. They're prepping supply chain adjustments for potential changes, but no big moves yet, given the uncertainty.
That U.S. factory must help, though.
Big time. They built that during the previous Trump administration, specifically for this kind of scenario, gives them flexibility.
Okay, now this next part sounded really interesting. Growth in defense and mission-critical networks.
Yeah, connecting things for defense, for first responders, critical infrastructure. They set up a dedicated unit in the U.S., Ericsson Federal Technology Group, to work with the Department of Defense.
Why is that net additive growth?
Because it's largely a new market. Building dedicated, secure, high-reliability 5G networks for these specific groups, public safety, military ability. It's not just replacing old tech. It's enabling completely new capabilities. Real-time video, sensor networks, secure comms, things that require dedicated 5G.
A greenfield opportunity.
Pretty much. High-value, specialized networks.
Okay, so pulling it all together for the investor context, why the sharp negative reaction again?
Well, as we said, fixation on the top-line miss. And the guidance wasn't explicitly raised for the full year, which some clearly wanted after the margin beat.
Specific worries about Q3 too.
Yeah, the Q3 network's sales outlook, expected to be below normal seasonality. Partially, that's just a mechanical effect, that big IPR chunk hit in Q2, pulling some revenue perception forward maybe.
And the India pause continuing into Q3 didn't help either.
Right. Plus, remember, the stock had already drifted off its May highs before the earnings, partly due to a softer Q1 outlook and some noise around the Vonage integration antitrust reviews.
So the market was maybe already a bit nervous, primed for disappointment on sales?
Could be. It seems the market right now is heavily weighting that immediate sales trajectory and overlooking some of the really positive underlying operational improvements and strategic positioning.
Which brings us nicely to our "this is not financial advice" segment. Outrageous but plausible trade idea.
Okay, let's do it. Given that market reaction, focusing purely on the sales miss and tariff worries, a contrarian idea could be a medium-term long on Ericsson stock.
Okay. Contrarian because the market just dumped it. Plausible because
the underlying operational story is strong, potentially much stronger than the headline reaction suggests. Look at the facts. Best gross margin in 3 years, OPEX significantly down, EBIT more than doubled.
Demonstrating real execution on costs and profitability.
Exactly. And those look like sustainable trends driven by structural changes, not just temporary fixes. Plus, they're making these crucial long-term bets.
5G standalone, AI, those mission-critical networks.
Right. Things the market, fixated on Q3 sales, might be underappreciating right now. And that focus on key home markets like India and Japan, yeah, there's a pause now, but strategically, it positions them for share gains when investment cycles turn back up.
So the outrageous part is betting the market has overreacted.
Well, essentially, yes. Betting that the market has thrown the baby out with the bathwater, discounting the stock too heavily on the sales miss and ignoring the powerful profit engine and the strategic shifts that could drive real value down the road.
It's a play on operational leverage, strategic resilience, future-proofing. Not just chasing the next quarter's revenue number.
That's the idea. A bet that solid fundamentals and strategic direction will eventually win out over short-term sentiment.
Interesting. Okay, so to wrap up this deep dive, Ericsson's Q2, definitely a mixed picture. Impressive profits, disciplined costs.
Against that backdrop of a top-line miss and market caution.
But they are actively pushing forward with strategic plays in 5GSA, AI, trying to build those future growth engines. What's the single biggest takeaway for you?
I think it's that Ericsson isn't just passively riding macro waves. They seem to be actively, maybe even aggressively, reshaping the business for better profitability and positioning for specific high-value growth areas. The market might not see it fully yet, but the internal transformation looks pretty significant.
Food for thought. As always, remember this discussion is just for informational purposes. It's definitely not financial advice. Please do your own research. Thanks for joining us for this deep dive into Ericsson's latest earnings. We always welcome your thoughts and questions.